Sonders and Nate Peterson to assess the market action and talk about the rest of this week with economic data ahead of us. Lizanne's Chief Investment Strategist, Nate Peterson's Director of Derivatives Analysis. What's up, guys? Good afternoon.
Hi.
Amazing team.
Hi.
Good to see you both. So, Lizanne, get us started here. I mean, did we hear something from Powell we liked today? It kind of sounded like more of the same, but the market has been running since, basically.
Yeah, more of the same, and he did what he has been doing, although more attention was given to it today and emphasizing the labor market. Oliver, you and I have talked about it quite a bit. Given the unlikelihood of core PCE getting down to the Fed's target this year, that puts some of the onus on further weakness in the labor market, especially on the wage side of things, to be supportive of the Fed moving sooner rather than later in terms of starting cuts. So as if Friday's jobs report wasn't already in focus, I think you add that to the mix. And I think with the JOLTS data coming out today, not as benign or as dovish as would be expected, I think it just really means the spotlight on a day where a lot of people would rather not be working probably are going to need to assess what Friday brings.
Good, because I'm here. And I'll be manning the desk.
I'll be in.
All right, nice. I want people to pay attention. I mean, pretty big data points. ISM services tomorrow, I feel like, is a really important print, too. Manufacturing was soft again, Lizanne, so we got to get that to hold 50.
Yeah, not only that, but I think the component parts, the prices paid component of it, the employment components. So I think the innards of PMI type reports are just as important as the headline readings. And I would say the same thing about the jobs report. It's not just about payrolls and the unemployment rate, but full-time employment versus part-time, wages, hours worked, the differential between the establishment survey and the household survey, revisions down to prior months, et cetera.
Okay. Right now, volatility is sub 12. If you're looking at the VIX, Nate, I mean, it seems like we're expecting all these things to hit right where we want them.
Yeah, it's just hovering basically around that low level or low end of the range, so to speak. I mean, it's actually overpriced if you look at the actualized volatility in the S&P 500, the historical volatility, what it actually does on a day-to-day basis. But there is perhaps some premium that's in there for some of the potential uncertainty that could arise. If you look at the VIX term structures, we get out to, October expiration, for example, it's above 17.5, which, it's a known unknown. But, you would think, hey, that's a pretty big rise. From 12, it is historically not so much. And it just speaks to this melt-up mode that I think we've seen that is and continues to be primarily tech-driven. If you look at the month of June, one of the best performing industries was software. Thank you, Oracle and Adobe, even after a lot of those companies within that industry happen to underperform, like your Workdays, your Salesforce, et cetera. So there's still this gravitational pull towards tech.
That is still something that it's just we can't ignore. All our guests have different ways to think about breadth, participation. The one we heard from Ed Clissold at the top of the show, I know you follow this, and his stat was the number of companies outperforming the S&P is at a record low year to date. So it's like the worst stock pickers environment ever if your option is to just buy the index. And then to Nate's point, they're all wrapped up with each other too. So, I mean, it's working for us for now, but is there still some danger there?
Well, I think the danger comes not so much just by a small handful of names driving performance of cap-weighted indexes. That is not abnormal. To your point, it's the very low share of the rest of the market that is outperforming the index. It's only 17% for the S&P over the past year, and it's only 15% over the past 6 months. So that's a very low share. So it's the combination of what's happening up the cap spectrum and the lack of participation elsewhere. The other important thing to point out, especially as we head into earnings season, is the appreciation in areas of leadership, whether it's the Magnificent Seven, whether it's the tech sector more broadly, has been greater at the cap contribution level than it has in terms of the earnings contribution. So you've seen price move exceed the move in terms of greater earnings into the mix for the overall S&P 500, which means you now have a larger share that is multiple expansion, and multiples are already stretched. Now, valuation is a terrible market timing tool. I would never suggest anybody use it as such, but it is that greater price appreciation than what the increase in earnings suggests, and that's important as we head into reporting season.
All right. Yeah, this is not too far off again for earnings ahead of us. with the day off too. Well, half day for us tomorrow. We're kind of got a weird kink sort of in the calendar as well, Nate. But generally, I mean, for as far as summer goes, lower volumes can create a little bit more, pockets, some air pockets. But it seems like, as KG pointed out just earlier, like we just keep drifting, like the market drift for all of the like options, skews and gamma, all that stuff. It just feels like there's pressure underneath.
Yeah, there is, and then you look at mega cap tech and you see Amazon new all-time highs, Alphabet new all-time highs,
Apple,
Microsoft
close.
new all-time highs, and then think about that psychologically, what that basically represents. It tells you that price discovery is still going on. They haven't failed to fair multiple, so to speak. It tells you that at least psychologically speaking, every dip buyer, if they have held, they're going to make money on those mega cap names. And I think a lot of this has to do with the AI and the innings that we're in terms of, you have 4 phases. Goldman put out 4 phases of the AI, growth cycle that we're in right here, this technological shift. We're in 1 to 2, and because it's an open-ended story and you can't quite quantify just how big that TAM is, and there hasn't been enough to really debunk it, this allows for multiple expansion, investor sentiment to kind of feed on itself, momentum to feed on itself. When we get to late July and August, then seasonally speaking, perhaps we can look for some type of perhaps mean reversion or profit-taking type of correction. Until then, it's like you have a permission slip to continue to kind of push them higher.
Yeah, all right, I like that. The imagination can run wild until, is obviously disproven. So the burden of disproof is on the cynics and the bears. All right, great stuff. Appreciate it, guys. Lizanne, Nate Peterson, always love the chat.